Welcome to another Life After Hours, the time of the month when we shine a searchlight into the dark recesses of personal finance. And tonight we're talking about behavioural investments. Your behaviour is one of the key drivers of your investment returns. And so tonight we're going to look at three biases that are going to affect how you get your returns. The reason this is important is that most investors underperform the funds in which they invest. It's got very little to do with fees. It's got little to do with taxes. It's about behaviour. And in practice, most investors generally pile in good times and withdraw in bad times. They might not sell out, but they stop investing. Whereas in almost every other sphere, when prices go down, we buy. Cyber Monday, Black Friday, New Year's sales, Boxing Day sales, that's when we spend. And yet we tend to do the opposite when it comes to investing. And that's why investors tend to do worse than what they invest in. And that's one of the big behavioural biases that I want to talk about. I've titled this session, Fix Your Portfolio from the Inside Out. And by inside, I mean inside your brain, inside your heart, not so much inside the spreadsheet or platform that you keep your portfolio on. This is particularly important for younger people. We have had an extraordinary run over the last 15 years. Markets have gone largely one way since 2010. In a period of generally low interest rates, generally low inflation, and modest economic growth. And so if you go back over that 15-year period, we had a negative year in 2018 if you were in a 80 or 100% equity portfolio. We had a down year in 2022 when both bonds and equities delivered an intra-year double-digit decline. And of course, we had the short, sharp COVID decline in 2020, where the market dropped 30% from the mid-February peak to the early April low. But it was all over by June 30. So 2020, the financial year, was actually a positive year, as was the calendar year. And of course, we were far more focused on staying alive than what was happening in our portfolio. Anyone under 40 certainly has no real visceral memory of what a serious downturn looks like. That's led many people into a false sense of security where all risk has been considered good risk and led to what I would call the cult of equities. That's by way of introduction to a general view that it's not just what you invest in that matters, but how your brain reacts along the way. And knowing yourself helps you stay the course during the downturn. And it's aligning your portfolio and your psychology that actually makes the difference. The three biases I wanted to cover tonight, the first of which is what I've just been talking about, the recency bias. And this is the bias that makes us place greater emphasis on what's just happened rather than the longer term story. And that's where this cult of equities comes in. It is very easy for people to say, well, look, the US outperforms Australia because that's what's happened in the recent past. It's certainly true over 5 years by a long shot. It's not true over 25 years, and it's not true over 125 years. So you do need to pick your horizon, and it is very easy for the human brain to focus on what's just happened. We do this with our budgeting as well. The first thing people think about when they think about budgeting is cutting out their morning coffee because that's the last thing they spent money on, whereas it's actually got a very minor impact on your spending. So that's recency bias. The second one, which I see all over the internet, and probably one of the reasons why the internet is bad for your wealth, is people taking research from one area and trying to apply that to others. And then the third one is this confusion between volatility and risk. They're two different things for the most part, risk is not the risk of you losing your money, because if you're investing in a broad-based, diversified portfolio, it's almost impossible to lose everything. But the real risk for most people is the risk of not achieving your goals. That's why volatility matters, and that's why volatility is the risk that we focus on. So with that, let's start and have a look at recency bias. You would say that US outperforms Australia and probably the rest of the world. Very true for the last 5 or so years, and that's been driven heavily by the so-called Magnificent Seven. If you go back to what's often referred to as the lost decade, so the period from 2000 to 2010, where the US market did next to nothing, there's a fallacy in concluding that recent past is good, and all I have to do is line up all of these ETFs by the highest returns and pick the highest returns ones. So I see a lot of people arguing, which ETF should I pick? And people go, invest in NDQ or IVV because that's what's done best over the last 5 years. That is not how to pick a portfolio. So the younger people generally, and for those of you who know me, know that most people are younger than me, and have just not experienced a downturn. And this is the fallacy that says if some's good, more must be better. And that's certainly not true when it comes to investing. Of course, we need growth assets in our portfolio. And if you're young and looking for growth, you need to be mostly in growth assets. But there's a long way from mostly in growth to 100% in equities. So the classic Reddit portfolio of VAS VGS VEU or VAS VTS VEU it's 100% large cap equities, and you're not getting rewarded for that. So diversity is the key, and less diversity equals more risk. This is one of the few free lunches when it comes to investing. So the next big one is to take good, solid, evidence-based research in one area and apply it to another. And nowhere is this truer than in the indexed versus active argument. There is no end of research that shows that, on average, active fund managers, that is stock pickers, do not, after fees and taxes, outperform indexed funds when it comes to large cap equities. So if you're buying large Australian companies, picking an active manager that will outperform the ASX 200 after fees is an extraordinarily difficult task to successfully navigate. It's not impossible, but not many funds do it, and identifying them ahead of time is extraordinary. There are some indicators that would help guide you to that. You need to find a fund manager when they're still small. You need to find a fund manager that's got a high active share. You need to find a fund manager that's got a lot of skin in the game. But that involves a bunch of research and risks that may or may not be appropriate. So for the most part, if you're investing in large company shares, indexed is a strong favorite in the race. That research misses out on some things that are demonstrated to outperform large companies. So small companies over time outperform big companies. Why? Because they're riskier, so you should be rewarded for investing in them. And of course, it's easier to double, triple the size of a billion-dollar company than it is to double or triple the size of the Commonwealth Bank. Small companies over time tend to outperform big companies. So in theory, if you simply bought the bottom end of the ASX 200, you would do better than buying the whole thing. In practice, given the structure of the Australian market, it hasn't actually worked out that way. But certainly investing in companies outside the ASX 300, there's clear evidence that you can add massive value. And when you look at the life cycle portfolios, that small exposure to small companies outside the ASX 300 has added about 0.6% to the annual return, which is a material change. It certainly increases the average cost of the funds because instead of being 0.04 or 0.07% like a Vanguard Australian Share Fund or a BlackRock Australian Share Fund, you're paying 1 to 1.5%. And even after allowing for that, the value a small cap manager can add adds some significant value. Also, we know that profitable companies outperform unprofitable companies. We know that the value companies, that is companies that trade on low multiples of their earnings, tend to outperform growth companies. That's not been true for the last 5 years with the power of the Magnificent Seven, for example, but it is true over time. These are what are known as factors. So the Nobel Prize winning research by Eugene Fama and Ken French identified these factors in the 70s, and they are remarkably persistent. So you can certainly apply those things to outperform the overall market. And when we talk about outperforming a market, first of all, you've got to identify your market. If the market you're talking about is large Australian companies, then you need to do something to beat the market. And we, therefore, generally would focus on an ASX 200 or ASX 300 indexed fund for our large company exposure, and then use active managers for the small companies. That index fund, it invests in the 200 or 300 companies in proportion to their size. So the largest companies being the Commonwealth Bank or BHP, depending on which day you look at it, they form the largest part of the fund. So it's about 10% in CBA if you buy an SX 200 fund. And BHP is 10 times the size of Origin Energy. So for every dollar you put in BHP, you put 10 cents in Origin. BHP is twice the size of CSL. And so for every dollar you have in BHP, you have 50 cents in CSL. And this has the nice impact of being self-cleaning. As companies outperform, one does better than the other, they naturally take up that position in your market. So you only need to rebalance when the index rebalances. And the company that was number 99 gets too small and falls out, and the company that was number 110 comes in, or 210, sorry, then the market rebalances. And so that gives you a very low turnover, low fee, good tracking of the index. The Australian market represents 2 to 3% of global share markets, depending on how you measure it. And so if you were to say, if I'm investing in Australia, I should invest in accordance with the ASX 200. If you take that same logic and apply it to the world, then you'd only be investing 2 to 3% in Australia. And that's clearly not the right answer for most Australians. It might be the right answer in the absence of taxes. It might be the right answer in the absence of currency exchange. It might be the right answer in the absence of regulatory differences. It might be the right answer in the absence of capital controls. But we live in the real world, and so using market size to allocate your capital between markets makes zero sense. And that would be what would happen if you simply bought the MSCI, the Morgan Stanley Capital Investors Index of global shares to create your global equity exposure. And just to put that in context, so if you look at the MSCI World Index, so that's the 23 developed markets that make up the bulk of the world, the US makes up 72.5% of that. So if you put $1 into a MSCI global fund, you are putting 72 cents of that into the US, which is out of all proportion to the size the US is in the world economy. So the US makes up about 26% of global GDP, or 15% if you look at it on purchasing power parity basis, and yet it's 72%. So does it make sense to put 72% of your global exposure into the US when it only makes up a quarter or less of the world? And for that reason, we use a separate US allocation. So we've been using IVV, the BlackRock S&P 500, which is the top 500 companies in the US, to create our US exposure, upweighting Asia and downweighting the old world in relative to where they would be in the MSCI index. Similarly, the bond market is a $141 trillion market. The total developed world equity market is about 76 trillion, or 85 if you include the developing markets. So nobody would take that analysis and say, therefore, you should have half as much again of your money in bonds as you do in shares. That's just a nonsense argument. And yet people do try to apply that argument to global allocations. I even saw a very prominent US financial advisor on an interview the other day where he was arguing the size of the Bitcoin market is 3% of the size of the global equities market. Therefore, you should put 3% of your money in Bitcoin. These are absurd arguments, but I do see them all the time. So that's the misapplied research piece. So when you see research, understand what it's telling you and where it's appropriate to apply it. Then the third one is volatility. You will find a lot of noise on the internet, especially on Reddit, where people will argue that volatility is not risk. And they're not precisely the same. When we research portfolios and we research investing, we do tend to focus on volatility as a measure of how much the value of a stock or a bond moves around, the wiggliness of the growth line, if you like. And many high-profile commentators will argue that that's not the same as risk. So Warren Buffett poo-poos the whole concept of volatility. Howard Marks is not a fan of using volatility as a measure of risk. And my good friend Nick Murray, who's probably one of my favourite writers when it comes to financial advice, he goes, in his words, the decline is temporary, the advance is inevitable, and therefore all you've got to do is hold your nose and stay the course. And certainly it's not a measure of the likelihood of loss these days. That when you're looking at a diversified portfolio, the concept of permanent loss of large chunks of capital is actually fairly difficult task to pull off these days. Where we as a group look at risk, to us it's always about the risk of achieving your goals. That the reason you're not spending this money today is so you can spend it in the future. There's a reason why you are setting aside this money for future spending. And there's usually a goal associated with that. And so the greater the volatility in your portfolio, the greater the variability of outcomes you're going to see, and therefore potentially the lower the probability of you achieving your goal. And that's why volatility matters. But it's not the only thing. It's really just one dimension of the risk and return equation, that you have to look at expected return and volatility together. And ideally what you want to be able to do is to maximize the return possibility for whatever given level of volatility you're prepared to stomach, or to minimize the volatility for the rate of return you need to achieve. And when we're trying to achieve our future goal, we really have three levers to pull. It's how much money we're prepared to invest, how long we're prepared to invest it for, and what level of return I'm going to generate. And the more you rely on the return to do the heavy lifting, the greater the volatility you've got to be prepared to accept. And so building a diversified, well-constructed portfolio is about achieving the right balance. So what you don't want to do is add more risk to your portfolio than you're adding return. So focusing on return per unit risk is the key to putting it together. And that's where we build portfolios. So the takeaway here is only accept risk that you're being rewarded for. And that's why we don't do individual companies. Additional risk of choosing a handful of shares is not rewarded over the potential return uplift. If you picked the four banks, you would have outperformed the four Australian big banks, so CBA, Westpac, ANZ, NAB, you would have outperformed the overall ASX 200, notwithstanding that they represent, I don't know, a fifth of it. You would have outperformed, but your volatility would have been huge. That's not true over all periods. So if you go back 20 years, you don't get the same outcome. But certainly over the last 5 or 7, and certainly if you picked the two high-performing ones, being Macquarie and CBA, you would have done even better. But you've got to pick your times. That's why we don't do individual shares. And that brings me on, I guess, to how do we pull this all together? I think message number 1 is don't take financial advice from the internet, especially from Reddit. That whilst individually, as we've seen, they're often reporting perfectly sound evidence-based research, but misapplying it. And there is a bit of a boys club bravado. I'm more growthy than you are. I'm a more aggressive investor than you are. And over time, it's not rewarded. And that then brings me on to the point I made earlier about you can't just line up the top performing ETFs or shares and pick the top 10. That's like picking the Australian cricket test team by listing everyone down by batting average and picking the top 11. That's not how you pick a winning cricket team. You need a blend of skills. And so you need diversification, you need the right tool for the right job, and you need to put them together in the right order. You can't get a return without taking risk, but you should be taking calculated risks. So I think they're the major points I wanted to make around behaviour and its flow through to investing. If you want to look at this in some more detail, there's a research house in the US called Dalbar, which does an annual survey of investors, mostly retail investors and mostly unadvised investors, and generates what it sees as the behaviour gap, which is the loss in return relative to what the market did based on this instinct to rush in when things are going hot and to pull back when things are not looking so good, whereas the math tells you should be doing the opposite. And that behaviour gap sort of runs up to 5%. Of the longer term, it's probably closer to 3%. Depends on the market you look at, but it's certainly in the equities market, it can be up to 5% a year, which when you're expecting the average Australian share market return over 125 years is about 12% a year. So 1, 2 or 3% difference is a huge portion of that expected return. And much of the benefit of a managed portfolio or an advisor is about stopping that behaviour gap. And that alone is worth the price of admission. So when we look at putting portfolios together and assessing your psychology, we use 2 tools. We used a traditional risk analysis, which dates back to the 80s. Research by Grable and Litton has formed the backbone of risk analysis or risk assessment for 40 years in financial advice. And that's what psychologists call a stated preference response. So that's you telling us how you feel about risk. That does change with time. And we find that most younger investors do tend to overestimate relative to where you would expect a bell curve to fall. And that's why we use a second tool, our money personality test, which looks at 13 psychological traits about why you do what you do with money and pulls those into 9 personalities. We actually use the traits more than the personalities themselves. And there are some of these money personalities that have dominant traits that impact on the way that you think and behave. One of those, for example, is self-determination. And that's about how much we believe success comes from our own efforts and how much we believe that luck plays a significant part in our results. Those who have high levels of self-determination tend to blame themselves when things go wrong, and that's a bad look when it comes to highly aggressive investing. Similarly with work ethic, there are people who believe if I work hard, I'll do well, So they tend to drift towards real estate as an investment, for example. And so managing these traits together with a stated preference is what allows us to look at your innate risk tolerance, and then we blend that with your capacity to recover. So a 20-year-old with big income and a small investment portfolio has a very high ability to recover, whereas a 70-year-old retiree has a very low ability to recover. So that's your capacity for risk. And then the final one is your need for risk. If you need a high level of return to achieve your goal, you're going to have to accept a higher risk in your portfolio. And if that level of risk is out of sync with the other two, you get this tension, and that's where people react badly when the downturn comes. And it will. There is a long history of 30% plus declines in equity markets around the world. We just haven't had one for a long time, but they do come along with monotonous regularity, or at least frequency, if not regularity. We do those with our members when we're doing specific pieces of one-on-one advice. It's also embedded in InvestBot, which is a front end to LifeSherpa Invest, which is our 4 risk-based portfolios, which you can buy directly on our website from $5,000. So go and check that out. If you want to get a copy of the book, you're probably going to have to search on eBay. There's not that many. It's been out of print for a very long time, but the research behind our money personality, which was done in the 80s, and it's been done probably not millions, but certainly more than 1 million times. We have a database of nearly 20,000 results, and there is a very strong correlation between the behaviour we observe in our members and the results of their money personality test. I reckon I can get it to about 2 of the 9 personalities within about 20 minutes of meeting somebody, but the quiz is available for everybody. So that's really the topic. Now, I've gone a little bit longer than we usually do. I like to try and keep this bit to under half of our session. We've just ticked over to 37 minutes. So now's the time to take some questions.